Hey everyone, and welcome back to the channel. Are you ready to make your money work harder for you in 2025? Today, we're diving into tax strategies that can make a huge difference in your financial life. You work hard for your money, and the last thing you want is to see a big chunk of it disappear come tax season. That's why we're going to break down simple, actionable steps you can take to keep more of your hard-earned cash. This isn't about complicated loopholes or shady schemes. It's about understanding the rules of the game and using them to your advantage. So grab a notebook, get comfy, and let's unlock the secrets to mastering your taxes in 2025. Now, you might be thinking, taxes? Ugh, that sounds boring and complicated. But trust me, taking control of your taxes is empowering. It's about making smart choices throughout the year to save money. Think of it as a puzzle. Deductions, credits, tax-advantaged accounts. Fit them together for financial well-being. We'll cover tax brackets, deductions, credits, and tax-efficient investing, breaking down complex concepts into bite-sized pieces. Remember, knowledge is power. Ready to unlock proactive tax planning? Let's get started. All right. Let's dive into the heart of the matter: tax brackets. In simple terms, tax brackets are like different levels of income that are taxed at different rates. Think of it like climbing a ladder. Each rung on the ladder represents a different tax bracket. And as you earn more income, you move up to the next rung. But here's the key takeaway. You only pay the higher tax rate on the portion of your income that falls within that specific bracket. We'll get into more detail about how this works in a bit, but first, let's clear up some common misconceptions about tax brackets. Let's talk about how tax brackets work. The US has a progressive tax system. The more you earn, the higher the tax rate. Lower earners pay lower rates. Higher earners pay higher rates. This ensures fairness in taxation. A common myth is that all your income is taxed at the highest rate once you reach a higher bracket. This isn't true. You only pay the higher rate on the income within that bracket. Income in lower brackets is taxed at lower rates. Understanding this can reduce anxiety and help you make informed decisions. Alright, now that we've got a handle on tax brackets, let's talk about two powerful tools that can help you save big time on your taxes: deductions and credits. These are like secret weapons in your financial arsenal, and understanding how to use them effectively can make a huge difference in your overall tax bill. Think of deductions and credits as valuable discounts on your taxes. They work in different ways, but both can significantly reduce the amount you owe. So let's unlock these tax-saving treasures and keep more money where it belongs, in your pocket. First up, let's talk about tax deductions. Remember those tax brackets we discussed earlier? Well, deductions can help you land in a lower tax bracket by reducing your taxable income. It's like shrinking the amount of your income that the IRS can even touch. Here's how it works. When you claim a deduction, you subtract that amount from your total income, which lowers the amount of income that's subject to taxes. This can result in significant tax savings, especially if you can bring your income down to a lower tax bracket. Now, there are two main types of deductions: standard deductions and itemized deductions. The standard deduction is a fixed amount that everyone can claim, regardless of their expenses. Choosing between the standard deduction and itemizing depends on your individual circumstances. Now, let's move on to tax credits. If deductions are like discounts, then credits are like getting cash back from the IRS. That's right, tax credits directly reduce the amount of tax you owe, dollar for dollar. Here's the key difference between deductions and credits. Deductions reduce your taxable income, while credits reduce your actual tax liability. This means that a $1,000 tax credit will save you $1,000 in taxes, regardless of your income level. On the other hand, a $1,000 deduction will only save you a portion of that amount, depending on your tax bracket. There are numerous tax credits available, each with its own set of eligibility requirements. Don't leave money on the table. We'll be discussing these credits in more detail in upcoming videos, so stay tuned. Now, let's talk about putting your money to work in the market with tax-efficient investing. Investing is crucial for building long-term wealth, but it's equally important to consider the tax implications of your investments. After all, you want to keep as much of your hard-earned returns as possible. The good news is that there are smart strategies to help you minimize your tax burden and maximize your investment growth. We're going to explore different types of investment accounts and how they can impact your tax liability. So, let's dive in and explore the world of tax-efficient investing together. Let's start by exploring tax-deferred accounts. These accounts are like cozy little shelters where your investments can grow and compound without being immediately taxed. Two of the most common tax-deferred accounts are 401ks and traditional IRAs. With these accounts, you contribute pre-tax dollars, meaning you get a tax deduction upfront. This contribution could lower your taxable income by $10,000, potentially saving you thousands in taxes that year. And here's the best part. Your money grows tax deferred, meaning you won't pay taxes on any earnings until you withdraw the funds in retirement. This tax deferred growth can make a huge difference in the long run, allowing your investments to compound and grow exponentially over time. It's like giving your money a turbo boost on the road to retirement. Now, let's talk about taxable accounts. These are your regular brokerage accounts, and while they don't offer the same upfront tax benefits as tax-deferred accounts, they do come with their own set of advantages. With taxable accounts, you fund them with after-tax dollars, meaning you've already paid taxes on that money. However, any dividends or capital gains you earn within these accounts will be taxed in the year you receive them. The good news is that long-term capital gains, gains on investments held for longer than a year, are taxed at a lower rate than your ordinary income tax rate. This favorable tax treatment of long-term capital gains is a significant advantage of taxable accounts. So while you might not get an upfront tax break, you can still benefit from lower tax rates on your investment profits in the long run. So far, we've focused a lot on investing. But what about those shorter-term savings goals? Don't worry, we've got you covered. Even if retirement is decades away, there are smart strategies to make sure your savings are working as hard as possible while minimizing your tax burden. Just like with investing, not all savings vehicles are created equal when it comes to taxes. Some accounts offer tax advantages that can help your money grow faster and shield your earnings from the taxman. So, let's dive into the world of tax-savvy saving. Let's start with a powerful tool that often gets overlooked: municipal bonds. These bonds, issued by state and local governments, offer a unique tax advantage that can be a game changer for your saving strategy. Here's the deal. The interest you earn on most municipal bonds is completely exempt from federal income taxes. That's right, the IRS won't take a dime of your earnings. And in many cases, you might even be exempt from state and local taxes depending on where you live and the bond you invest in. This tax-free income can be incredibly appealing, especially for those in higher tax brackets. Remember those capital gains taxes we talked about earlier? Well, here's a powerful strategy to reduce your tax burden. When selling investments for a profit, focus on long-term capital gains. As a quick refresher, short-term capital gains, profits on assets held for 1 year or less, are taxed as ordinary income. However, long-term capital gains, profits on assets held for more than 1 year, are taxed at a much lower rate. In fact, for many taxpayers, the long-term capital gains tax rate is 0%. That's right, you could potentially keep every dollar of your profits. This favorable tax treatment of long-term capital gains incentivizes holding on to investments for the long haul. So the next time you're considering selling an investment, remember the power of the long game and the potential tax savings it can bring. There you have it, folks. We've covered tax brackets, deductions, and smart investing strategies. Remember, tax planning is about taking control of your financial well-being. Every step you take brings you closer to your financial goals. Start planning now and empower yourself to make smart financial decisions. I hope you found this video helpful and empowering. Remember, this is just the beginning of our journey to financial wellness. I'll be sharing more tips, strategies, and insights in future videos. So be sure to hit that subscribe button and turn on notifications so you don't miss out. And hey, if you found this video valuable, please give it a thumbs up and share it with your friends, family, and anyone else who could benefit from a little tax-savvy advice. Let's spread the knowledge and empower each other to take control of our financial futures. Thanks for watching, and remember, you've got this. I'm here to support you every step of the way. Until next time, stay informed, stay empowered, and keep making those smart money moves.